It didn't start with panic. It started with applause. 8:30 a.m. The jobs report hit the wire. 130,000 jobs added. Unemployment steady. For exactly 9 minutes, everything looked fine. Then the floor gave way. Futures reversed. Algorithms flipped from buy to sell. Treasury yield spiked. And by the closing bell, $4.2 trillion in market value had evaporated. A 15% correction triggered not by war, not by a banking collapse, not by a black swan, but by a strong jobs report. That's the paradox. This wasn't supposed to happen. The headline number looked stable. Financial anchors called it resilient. Commentators used words like balanced, steady, cooling, but healthy. But markets don't move on headlines. They move on what the headlines mean. And what this report revealed was something far more dangerous than weakness. It revealed a trap, because buried beneath the job gains was a brutal revision, hundreds of thousands of previously reported jobs quietly erased from the record. Months of growth suddenly downgraded. Momentum that once looked steady now looked flat. What investors thought was expansion was actually stagnation. And stagnation in today's market is lethal. Here's why. For 2 years, markets have been pricing in a very specific narrative. Inflation cooling. Growth slowing but not collapsing. The Federal Reserve preparing to cut rates. A soft landing. Stocks didn't rally because earnings exploded. They rallied because investors believed the Fed would soon pivot. Every multiple expansion, every AI-fueled surge, every record high was built on one assumption. Rate cuts are coming. But strong jobs data, even mediocre strong delays that pivot. And when rate cuts get delayed, valuations get squeezed. The moment traders realized the labor market wasn't cooling fast enough. The moment they realized inflation pressures might stay sticky. The moment they understood the Fed might keep policy restrictive longer. The sell orders began cascading. Because this market isn't priced for okay. It's priced for perfection. And perfection just cracked. What makes this correction so unsettling isn't the speed, it's the structure. Look beneath the surface, and you'll see something disturbing. Layoffs have quietly climbed toward recession-era levels. Full-time jobs are being replaced with part-time roles. Temporary help employment is contracting, historically a leading indicator of downturns. Credit card delinquencies are rising. Small business hiring is slowing. Yet the unemployment rate barely moved. Why? Because the unemployment rate doesn't measure fragility. It measures participation within narrow definitions. It doesn't capture underemployment. It doesn't capture multiple job holders forced to work 2 positions. It doesn't capture workers who stopped looking. So while headlines say stable, the internals whisper strain. And markets heard the whisper. That's what Thursday was. Not a crash. Not a crisis. A repricing of expectations. And repricings hurt the most when optimism is extreme. Consider where we stood before the shock. Major indices near record highs. The market dominated by 7 megacap stocks, carrying an outsized share of returns. Valuation metrics stretched. Retail participation elevated. Volatility near historic lows. When volatility is compressed, risk feels invisible. But risk doesn't disappear. It accumulates, like pressure beneath tectonic plates. The jobs report didn't cause weakness. It exposed tension that was already there. And when tension meets disappointment, even mild disappointment markets don't gently adjust. They snap. What happened Thursday was not about 130,000 jobs. It was about narrative collapse. For months, investors convinced themselves that the economy could slow without breaking, that inflation could fade without unemployment rising, that earnings could remain strong even with high interest rates, that rate cuts would arrive right on schedule. That belief justified extreme valuations. But what if growth isn't accelerating? What if the labor market is cooling too slowly to justify cuts, yet weakening enough to hurt profits? That's the nightmare scenario. Growth too strong for relief, too weak for expansion. The worst of both worlds. And markets are starting to price it in. The 15% correction wasn't random. It was a recognition. A realization that the path forward isn't smooth, that monetary policy may stay tight longer, that earnings expectations might be too optimistic, that liquidity, the fuel of every rally, isn't as abundant as traders assumed. Corrections don't begin with sirens. They begin with subtle shifts in probability. On Thursday, probabilities shifted. Rate cut odds fell. Bond yield adjusted. Discount rates rose. Valuation models recalibrated. And when you recalibrate high multiple growth stocks with higher discount rates, you don't get small moves. You get air pockets. The speed of the drop tells you something else. This market was crowded, positioned aggressively, leveraged in places few were watching. When the data hit, it forced systematic funds to reduce exposure. Volatility targeting strategies cut risk. Momentum strategies flipped. Passive flows couldn't cushion the decline. The result? A synchronized unwind. And here's the uncomfortable truth. This may not be the end of the move, because corrections tied to policy expectations don't resolve in a single day. They evolve. They test confidence. They force investors to choose between faith and fundamentals. And right now, fundamentals are sending mixed signals. That's dangerous, because uncertainty, not weakness, is what destabilizes markets. Thursday wasn't about fear. It was about recalibration. And recalibrations mark turning points. The question now isn't, why did the market fall? The real question is, was Thursday a healthy reset, or the first crack in something much larger? That's what we're about to uncover. The market didn't fall because of a single number. It fell because the number disrupted a story investors desperately wanted to believe. For months, Wall Street operated under a synchronized assumption. Inflation was cooling, growth was slowing gracefully, and the Federal Reserve would soon begin easing policy. This expectation justified elevated equity valuations, narrow leadership concentration, and record levels of passive inflows into index funds. But the labor market report complicated that narrative. 130,000 jobs added sound stable. It sounds manageable. It sounds like the kind of number policymakers describe as balanced. But markets are forward-looking machines. They don't react to what happened. They react to what it implies. And this report implied something uncomfortable. The economy isn't weak enough to force rate cuts, but it may be too fragile to support elevated earnings expectations. That tension is explosive. The revision shock, the most overlooked detail, wasn't the headline gain, it was the massive downward revisions to prior months. When previously reported job growth gets revised lower by hundreds of thousands, it changes trajectory. Momentum matters more than level. A steady deceleration signals something very different than stability. Revisions like this undermine confidence in trend strength. They suggest earlier optimism was overstated. They introduce doubt into models built on consistent labor resilience. Investors don't fear slow growth as much as they fear misjudged growth. Because if analysts misjudged labor strength, what else are they misjudging? Corporate earnings? Consumer spending durability? Small business hiring plans? Confidence cracks quickly when data reliability comes into question. Why 130,000 jobs isn't comforting in isolation. 130,000 jobs is neither catastrophic nor booming. But context changes interpretation. Population growth requires roughly 100,000 to 125,000 new jobs per month just to maintain equilibrium in the labor market. That means 130,000 barely clears the bar. It signals maintenance, not expansion. Maintenance doesn't justify premium multiples. Maintenance doesn't justify euphoric AI-driven market caps. Maintenance doesn't justify price-to-earnings ratios hovering near historic extremes. Yet valuations were pricing acceleration. That disconnect is what triggered repricing. The Federal Reserve trap. Here's the policy dilemma. If the labor market stays firm, inflation risks remain. If inflation risks remain, the Federal Reserve keeps rates elevated. And high rates compress equity valuations. Equities are valued by discounting future earnings back to the present. The higher the discount rate, the lower the present value of those future cash flows. When interest rates rise or remain high longer than expected, high-growth stocks suffer disproportionately. This correction wasn't random selling. It was mathematics. Even modest changes in rate expectations can dramatically alter valuation models when markets are trading at stretched multiples. And that's exactly where we were. The concentration risk problem before the correction. A small cluster of megacap technology stocks accounted for an outsized share of index performance. 7 companies carried the bulk of gains. When leadership narrows that dramatically, fragility increases. Because if even one pillar weakens, the index feels it. And if investors begin to question forward earnings projections for those companies, especially in AI infrastructure, spending the unwind becomes magnified. The correction revealed how dependent the broader market had become on a handful of names. Diversification existed on paper, but performance was concentrated. That's structural risk. The AI premium question, much of the market's recent valuation expansion was fueled by AI enthusiasm, AI productivity gains, AI enterprise adoption, AI chip demand, AI-driven earnings acceleration. But expectations outran timelines. Revenue realization often lags investment cycles. If rate cuts get delayed, corporate capital expenditures may slow. That affects AI deployment budgets. Suddenly, projections built on exponential growth require recalibration, not abandonment. Recalibration. And markets adjust aggressively when narratives shift. Labor market blind spots, the unemployment rate remains low. But unemployment is a lagging indicator. It tells you where stress has already occurred, not where it's forming. More telling metrics include temporary help services employment, often a leading downturn signal. Multiple job holders, rising average weekly hours, trending lower, layoff announcements, increasing participation rate stagnation. When companies reduce hours before reducing headcount, stress builds quietly. And when hours fall, wage growth moderates, impacting consumer spending. Consumption drives roughly 70% of U.S. GDP. So even subtle labor softness carries macro implications. Markets sense this. Credit market whispers, equity markets move fast. Credit markets move thoughtfully. And lately, credit spreads have begun widening subtly. Not crisis widening, but cautious widening. Credit investors focus on default probability and refinancing risk. With higher interest rates, corporate debt servicing costs increase. Companies that borrowed cheaply years ago now face refinancing at higher yields. That compresses margins. And margin compression pressures earnings. Equities respond preemptively. The cockroach theory in credit markets suggests that when you see one issue, others are likely hiding nearby. Thursday's correction may have been equities' reaction to credit's early signals. The election year pattern historically, midterm election cycles often introduce volatility. Policy uncertainty increases. Fiscal positioning shifts. Market liquidity patterns adjust. While history doesn't repeat perfectly, patterns influence positioning. Traders aware of seasonal correction tendencies may reduce risk faster when catalysts appear. The jobs report became that catalyst. The liquidity factor markets are not just earnings machines. They are liquidity machines. When central banks tighten policy, liquidity drains gradually. When fiscal stimulus fades, liquidity contracts further. When rate cuts are delayed, liquidity expectations shrink. Less liquidity means less tolerance for valuation extremes. Liquidity doesn't disappear overnight, but it thins. And thin liquidity amplifies volatility. That's what we saw Thursday. 3 scenarios for 2026 after a 15% correction. The path forward typically branches. Scenario 1. Soft landing stabilization, growth slows but doesn't collapse. Inflation gradually fades. The Fed begins modest rate cuts. Valuations compress but earnings stabilize. Markets consolidate before resuming gradual gains. Scenario 2. Stagflationary pressure, growth stagnates. Inflation proves sticky. Rates remain high. Margins compress. Equities struggle sideways or drift lower. Scenario 3. Hard landing, labor weakness accelerates. Consumer spending contracts. Corporate earnings fall sharply. The Fed cuts aggressively, but too late. Markets overshoot downward before bottoming. Thursday's correction suggests markets are moving probabilities away from scenario 1 toward 2, with a tail risk of 3. But probabilities evolve, and markets are dynamic. The psychological layer corrections aren't purely economic. They're psychological resets. When investors grow accustomed to buying every dip successfully, risk tolerance expands. When a dip doesn't immediately rebound, confidence falters. If subsequent rallies fail to make new highs, behavior shifts. Institutional allocators rebalance. Retail investors hesitate. Volatility increases. Momentum can reverse faster than fundamentals deteriorate. Thursday may mark that pivot. Is this a crash? No, not yet. Crashes require systemic shock or liquidity freeze. What we saw was valuation compression driven by policy expectation adjustment. But compression can evolve if earnings disappoint. And earnings depend on labor durability and consumer strength. Which brings us back to the original shock. The jobs report wasn't catastrophic. It was inconvenient. And inconvenience, when markets are priced for perfection, can be destabilizing. What comes next? The next few data releases matter enormously. Inflation prints, retail sales, corporate guidance, credit conditions surveys. If data confirms gradual cooling without collapse, stabilization could occur. If revisions continue downward and layoffs accelerate, confidence may erode further. Markets don't need disasters to fall. They need narratives to weaken. And Thursday weakened a powerful narrative. Not destroyed it, weakened it. That distinction matters. Because markets rarely move in straight lines. Corrections test conviction. And the coming weeks will determine whether this was a sharp reset or the beginning of a deeper repricing cycle. Markets don't collapse in darkness. They collapse in broad daylight. They fall when everything looks fine. When headlines say resilient. When analysts say soft landing. When portfolios feel invincible. That's why Thursday matters. Because nothing broke. There was no emergency rate hike, no bank failure, no geopolitical explosion, just data, just a jobs report. And yet, a 15% correction unfolded with astonishing speed. That tells you something profound. The market wasn't reacting to weakness. It was reacting to misalignment. Misalignment between expectations and reality. Misalignment between valuation and growth. Misalignment between narrative and probability. And when misalignment becomes too large, gravity steps in. The illusion of stability for months, volatility had been suppressed. Every dip was bought. Every earnings miss was excused. Every risk was reframed as opportunity. When volatility compresses, investors begin mistaking calm for safety. But calm and safety are not the same. Calm can exist right before turbulence. The labor data didn't scream recession. It whispered friction. And friction is dangerous when leverage is high and positioning is crowded. Because crowded trades don't unwind politely. They unwind violently. Why this correction feels different? Every correction feels painful in the moment. But this one exposed something structural. It revealed how dependent the market had become on imminent rate cuts, AI-fueled earnings acceleration, mega-cap leadership, liquidity, resilience. Remove just one of those pillars, and the structure wobbles. Remove two, and repricing accelerates. Thursday questioned the rate cut timeline. That alone was enough. Because when the cost of capital stays high, the entire valuation architecture must adjust. High multiples shrink. Speculative premiums fade. Risk appetite cools. It's not dramatic. It's mathematical. The dangerous middle, the most unstable economic phase isn't boom. It isn't recession. It's the middle. The phase where growth slows but doesn't collapse. Where inflation declines but doesn't disappear. Where unemployment rises slowly, not suddenly. In that middle zone, policy becomes uncertain. And markets hate uncertainty more than weakness. If the economy were clearly collapsing, rate cuts would come quickly. If the economy were clearly booming, earnings would justify valuations. But when the economy is ambiguous, Investors must constantly reassess probabilities. And reassessment drives volatility. That's the phase we may be entering. The confidence variable markets run on confidence. Confidence in earnings forecasts. Confidence in central bank timing. Confidence in consumer resilience. Confidence in liquidity depth. When confidence erodes gradually, prices don't crash instantly. They drift lower. They rebound weakly. They fail at resistance. They become choppy. Corrections transform into environments. And environments shape behavior. If investors stop believing that every dip is a gift, positioning changes. Risk budgets shrink. Cash allocations rise. Speculation cools. That behavioral shift can extend volatility far beyond the initial shock. The Fed's invisible role. The Federal Reserve didn't say anything new on Thursday. But markets interpreted the data as a reason for the Fed to stay patient. Patience in a high-rate environment is restrictive. Restrictive policy tightens financial conditions. Tight financial conditions squeeze margins and borrowing capacity. That squeeze doesn't show up overnight. It accumulates. And equity markets often price the accumulation before it becomes visible in GDP. That's why this correction deserves attention. Not because it guarantees recession, but because it signals tightening tolerance for optimism. What smart capital watches, now professional capital allocators, aren't asking. Will the market bounce tomorrow? They're asking. Are earnings estimates too high? Are credit spreads signaling deeper strain? Are revisions accelerating? Is consumer demand slowing? Is liquidity thinning further? These are slow-burning variables. They don't trend on social media, but they determine direction. The speed of Thursday's decline tells you positioning was stretched. The aftermath will tell you whether fundamentals are cracking. The 3 psychological phases after a shock denial. This is just profit-taking. Debate, maybe something changed. Decision, I need to reposition. We're entering phase 2. Debate. The debate over whether the labor market is stronger than it looks or weaker than it appears. The debate over whether rate cuts are delayed or derailed. The debate over whether AI growth justifies valuations or inflated them. Markets move during debate. They stabilize only after decisions. This is not doom, let's be clear. A 15% correction is not collapse. It's historically normal, healthy even. Markets need resets. They need excess trimmed. They need leverage reduced. They need expectations recalibrated. What makes this moment significant isn't the percentage drop. It's what triggered it. Data that looked fine but implied constraints. That's subtle. And subtle shifts can have large consequences when optimism is high. The bigger lesson of Thursday isn't about jobs. It's about fragility in perfection. When markets are priced for flawless execution, even minor imperfections create volatility. When narratives dominate fundamentals, surprises sting more. When liquidity thins quietly, moves accelerate. Investors who understand this don't panic. They analyze. They measure probability shifts. They adapt. What happens if inflation cools faster than expected? Rate cuts could revive momentum. If earnings surprise upward, confidence could rebuild. If labor remains stable without overheating, balance could return. But if revisions continue downward, if layoffs accelerate, if consumer spending slows meaningfully, then this correction may deepen before stabilizing. Markets don't need catastrophe to fall further. They need uncertainty to linger. The real shockwave wasn't the 15% drop. It was the realization that the path forward isn't linear, that policy isn't guaranteed, that growth isn't accelerating, that valuation extremes require perfection, and perfection is rare, very rare. Final thought: markets don't crash because bad news appears. They crash when good news stops being good enough. Thursday may have been the first signal that good enough is fading, or it may simply be a healthy reset in a long cycle. The difference will be revealed in the data ahead. Until then, this isn't about fear. It's about discipline. It's about recognizing that optimism and reality must eventually reconcile. And when they do, the adjustment can be swift. Thursday was swift. The question now is simple. Was that gravity doing its job? Or was it just the beginning of something larger? Only the next wave of data will answer that. But one thing is certain. The illusion of effortless gains has cracked. And once cracks appear, markets never look quite the same again.